Welcome to Money on Tap, your personal finance headquarters where we bring out the professionals, experience, and some fun in what we call three-dimensional investing, utilizing insurance, brokerage, and fee-based planning. And we believe that all investments have merit and all investments have relevance to a time and place. Depending on you, your objectives, and your goals, my name is Seth Krussman, and I'm joined here once again by John Ryder and Ben Brayshaw. How are you guys today?
Excellent. Good afternoon, Seth.
Good afternoon, Seth. Seth, so professionals and John Ryder are with us today, correct?
Hey, that was kind of a low blow, but you know what? We got some more stuff coming back at Ben today. Trust me. Trust me.
Since I see the show notes, I'm taking some early hits.
We are all
first round.
We are all planners, partners, and friends
and professionals
at Brayshaw Financial Group. And we're glad to have you listening to Money on Tap. And if you're looking to sit down with an advisor, start making some of the right steps towards your financial goals, we welcome the opportunity to do that with you. You can reach us at 855-226-8551 or email us at info@yourmoneyontap.com. You can also find us at Facebook at Money on Tap, and if you head over to yourmoneyontap.com, you will actually see pictures of Ben, John, and myself.
You may not want to head over to Your Money on Tap, but anyway.
It's not the going recommendation, right?
I recommend not downloading the pictures when you open the website.
We're going to do a buy, sell, hold on that idea. I'm going to hold. Today we're going to spend the majority of our show talking about a demographic shift that we're seeing take place in our country. And we're seeing our country age like never before. And as an investor, it's important to make sure that you are aware of what's happening and to make adjustments as needed.
Hey, sometimes we need to make adjustments when it comes to our money. I think I've told you guys this before, but I'm going to tell you again. I grew up in Rhode Island. My dad was a boat builder, and he had a company there in Rhode Island, had it for over 25 years. But throughout the course of having that business, there were lots of ups and downs along the way. Sometimes there was issues with cash flow, sometimes there's issues with production. But he had a good-sized company and made over 2,500 sailboats throughout the course of his career, and really had a great company. But there's certainly ups and downs. I remember there was in my parents' living room, they had a picture, and there's a poem, and that poem had some words on it that I think are very true, that really talks about really sometimes adjusting the sails no matter what situation we're in. Sometimes when we're sitting down with investors, we'll talk to them about maybe shifting the sails a little bit with the way that they have their 401k allocated, maybe shifting the sails a little bit with how they have their investments currently set. But I'm just going to recite this for you again. One ship drives east and another drives west with the self-same winds that blow. 'Tis the set of the sails and not the gales which tells us the way to go. Like the winds of the seas are the ways of fate as we voyage along through life. 'Tis the set of the soul that decides its goal and not the calmer strife. So, in today's show, we're going to spend some time talking about what's going on in our country from a demographic perspective. And it's probably time for some of you that are listening today to start thinking about perhaps adjusting the sails a little bit differently. Maybe you want to get to one place someday. There's a point that you want to get to someday when it comes to your retirement. That you, for instance, want to retire at maybe age 67. That you want to be able to sell your house, whatever it may be. One of the main things that I find out when we're talking with people is the fact that people don't want to adjust their sails. They don't want to change things. Sometimes people are a creature of habit, but sometimes when it comes to retirement, it's very important to be able to have to make adjustments as we go. But before we talk about some of those changes, I'd like to highlight a story that I recently came across in the Wall Street Journal. This is actually back from March of this year, but the article was written by Corey Dreisbach and Aaron Kurtoloff. But I just wanted to highlight that a little bit and talk about really some changes that many people seem to be making. In the article, it talks about how stocks are hitting record high after record high. This is back in March, but the thing is, it hasn't changed a whole lot, has it? We keep on seeing record highs, whether it be we had a little falling off of the NASDAQ here recently, but for the most part, we keep on seeing things go up and up and up. But as far as that is concerned, I just wanted everyone to understand that stocks hitting record highs It won't continue to do that. And Seth, I don't know, do you have the article in front of you, Seth?
I do. And one of the things, reasons I think we kind of stopped doing some of the economic updates was because it's like all these record highs. It just stopped even having any impact. I'm like, oh yeah, here we are, another high, another day. Okay, well, I don't know. Oil dropped a couple of bips. Yeah, oh well, whatever. Let's go.
Seriously, it was getting a little boring. I agree, and I'm glad we removed that temporarily. But I think the thing is that people are not looking at the important items in the market, right? I mean, everyone's looking at the market from, this is what the S&P is doing, and the Dow's doing, and the tech, and the this, and the that. But the truth is what is swinging all the money in this country? And that's what we're here to talk about today. We've got two demographics. We talk about the one that's probably the most significant right now, which is the baby boomers. And the reason we talk about them the most is because they have all the money. I mean, they're the ones that are really, they are
the purse strings.
Yeah, they're the tail, wagging the dog kind of thing in this country right now financially. Then the other side of this piece that's very interesting is that you have the millennials, which is the spending power, right? So you have the baby boomers who are investing, and then you have the millennials who are spending in different areas, and you've got these two overweighted classes. And I think we've talked about this a lot regarding the aging America, how that's going to affect your portfolio, and what you're going to do, and how you can address those things, and how you can look at it. And today I think we're going to talk and debate out a little bit on some of the numbers here, because it's like we've got numbers all over the place, which are really interesting. But the truth is we all know it's a huge number, and I'm kind of excited to talk about this. John, you've got a great website here that we're gonna dive into, which I think is really cool. Helps support a lot of the conversation that we've had over the past year or so on the aging American, trying to educate people on how to invest around that demographic.
So we've already kind of taken off course, not to go ultra nautical with you, Major John.
Okay.
But
Captain John.
Captain.
I was going with the major because there was a lot of majors getting dropped in there before we got into the old poem there. But I'll go with Captain either way. So the ups and the downs of our. All right, stop there. The article that you brought up was beautiful. It was from March, but it's a story that we're just becoming more and more familiar with, where the population that is retired or is in retirement, and this is, everybody that seems to be kind of age 75 north, that especially that retirement age that happened in that last pullback from 2007, 2008, and 9. The story just highlights a gentleman that retired during that time, was a dentist, and then had to go back to work because half of that portfolio disappeared. Right? All those retirement dollars that he was planning to be able to rely on no longer were there. And then second to that, the caveat was that there was no way to drive income, because what the model was, and this was what he, articulates, was his father, when he was in retirement, was getting 15% on a CD.
Right.
And then the typical, bond to stock blend has been, based on your age and your retirement and your kind of target retirement. We've got a stock weighting of X and a bond weighting of B, and usually stocks were the higher weighting in early onset, and then it kind of moved progressively towards more bonds, because the bonds were going to create the income and stability in retirement. And what the article and this guy's story illustrates is that was not a possibility. Unless, of course, he had a much larger nest egg. That was one way to do it, is you either got to have more money, or with the money that he has, he's got to find a way to get income. And so he's, 95% of his portfolio has been in stocks, basically,
so
to try to recover.
I'm going to take a lot more risk in order to be able to recover there.
Okay, but why in 2008 though? Right? Why did I'm rhetorically asking this. Why in 2008 did the market drop and plummet so deep on all of those different plateaus, right? You'd be watching the market, it'd plummet.
Across the board.
Right, across the board. And then all of a sudden it'd pause, and then a few days later, plummet again. A few days later, plummet again. Right? You kept having these different like levels of crisis, and then it would stay there for a week or so, and then all of a sudden it plummet again. And I think what people don't realize is the power inside the investor. Like that's there's like different levels of fear, right? And then you got different trades happening automatically too. Some protection mechanisms.
More now than ever.
Yeah.
More now than ever.
And so we've set ourselves up because of those automatic trades to cause these repetitive plummets as things drop, right? Because people have set those bars even higher now or closer to their call. And so when they say, hey, listen, if I own Apple stock at $150 a share and it goes to 140, I just want to sell it out. A swing like that in our market today is not that big of a deal. That's one of the things that's really scary, is because as we work through our market, we're looking at this demographic, and honestly, in 2008, you have all these people who are just these baby boomers who are at the front end of retiring, and they're saying, "Oh my gosh, the whole market's falling apart. Gosh, I got to save some of this. Oh, I got to save more of this. Oh, or the guy who's saying, "Oh, I'll hang on, we'll be fine." Oh my gosh, I just lost half my money. Just get me out. I'm going to have to work the rest of my life to actually retire.
And we saw that happen.
That's what happened in 2008.
Over and over. Yeah.
Right, because we saw people get out. We saw the market crash. We saw more people get out. We saw hedge funds. We saw all sorts of different organizations getting out. And then people started selling more and more. And you just had this back and forth, almost like a ping pong table, volleying all the different things from institutional to, individual, And that was this crisis fall. And that's where those pauses were, is that you're just waiting for the next play. And I think we as a society never realized how much power that demographic had.
And really what we're seeing now, and what we're going to spend the rest of our show talking about today, is we're going to be talking about what is going on in the United States of America. Of course, we look at investing in international stocks and global stocks, that type of thing. But, here in the United States, we have what we call a demographic crisis, I guess you should say, in the fact that the U.S. has reached a new milestone. We have a population of over 50 million seniors for the first time in the history of the United States. So we're seeing people every day. Ben, I think I've told you this statistic before. We've talked about it. Over 10,000 people a day are having their 61st birthday, and it keeps on going. We're going to have a lot of people that are getting into their retirement years, and that really forces a lot of different changes. And I thought what we'd do is really kind of talk about we're referencing a website here, and you're welcome to follow along with us, seniorcare.com. And it talks
Is your name on there, John?
It is not on there yet, but Ben, probably coming up.
You are our
soon.
senior advisor, John.
I am called the senior advisor.
For all those who don't know, we tease John. He's our senior advisor here.
Yes,
in the office.
Yes, I am much wiser, John the Wise. But here's the problem: 50 million seniors, more than the population of 25 states combined. So we have people.
Now this is interesting, and we were just talking about this. 50 million is the highest number I've ever seen so far to date as the current population over 65.
That's the most ever, yeah.
That's the most I've ever seen listed. So this website was interesting when you showed it to me, because I was like, boy, I'm in the 35 to 40 million based on the number stuff that we've crunched, in different areas. So this website is really interesting. And I was wondering, Seth, how much of this potentially is, either illegal aliens, where the count's coming from, all the different things, like all these, what's really interesting.
Do you mean like, are you talking about like, oh, never mind.
People,
go ahead.
Aliens.
Yeah. Aliens. Yeah, okay.
Right.
Illegal.
Like abductions, like people abduction.
I know people are going to listen to say, well, there's not 10 million or whatever, but there is a considerable amount of people that are or are aging into this too, that, all the different things. This is the highest number I've ever seen. 42 was the highest I had seen before that.
Yeah.
From a legitimate source.
So the question is, what is causing the aging population growth? And, as we delve into it a little bit more, what we're finding is that people that are born today, someone born in 2017, they have a lot longer life expectancy than someone was born in 1900. So we're seeing that really shift up quite a bit as far as the life expectancy. So this is obviously what actuaries are looking at when they're pricing life insurance. So that's why we've even seen life insurance come down in price. But we're going to get back to you in just a minute, just talking about what are some of the main causes of people living longer and longer.
Yeah. Well, and I think that's interesting too, because as you go through this, and I think we are going to bounce more into this, but their expectation of life expectancy is not nearly as long as what is out there. I mean, they have it going out for a woman.
Seniorcare.com.
Yeah, the senior. Yeah, I mean it's. In 2010, they're saying a woman lives to 81 years old.
They're living longer than that.
They're living so much. I mean, I have so many clients. I mean, I had a woman client of mine pass away recently, 92, and not an issue at all. So.
We'll be right back with Money on Tap. We're going to take a quick break. You can reach us at 855-226-8551 or come find us at yourmoneyontap.com.
On this Cliff Notes edition of Money on Tap, John Ryder and Ben Brayshaw discuss some of the pitfalls that come with poor financial planning in retirement and the necessity for a healthy strategy to make the most of your money in your later years.
I have $500,000 for my retirement, but I really want to drive a Maserati.
In which I need to pay cash for most of the time.
Yeah. So I guess I haven't looked at the list price of a Maserati lately, but
a couple $100,000.
Yeah. So probably not wise, but so that might be an exaggeration of someone spending money. But you know what? Oftentimes we see people will look at maybe buying a second home a few years before they retire. They're not downsizing their current home, but they're buying a second home without really thinking about, hey, I need to think about income streams. I need to think about how much money I'm going to need on a monthly basis once I retire.
I mean, I have seen so many different people blow it early. They have these things that they feel like they need to do, and, they're going to just lump sum cash out. I mean, I've seen where people get very afraid about retirement and all the expenses. I worked with one person one time in which they wanted to put 3 years' worth of expenses in cash. I mean, we might have even been 4. And I remember sitting next to one of the other planners there, and it was like, and the expenses were 4 years worth of taxes. I was like, well, if you can't create enough income to cover your current expenses that you're so afraid you got to put 4 years away, you're really not planning for retirement. You're planning for a period of time. It's like a vacation, your 4-year vacation.
Sure. I think a lot of retirees fall into the trap of overdoing it right after they stop working. So they have all this free time on their hands, and now it's time to put on the new deck. Now it's time to get all new appliances. Now it's time to do all this stuff. So they have more free time, but maybe less discretionary income than they've ever had before.
The around the world trip?
Yeah, exactly. So it can also have some pretty major repercussions on a retirement plan. So one of the biggest risks that you face after you retire is called the sequence of returns risk. So it basically says that if you have a big hit to your finances, you'll have a greater impact earlier in your retirement plan. So if you lose a lot of money early on in your retirement plan, that can really wreak havoc for funding your retirement later on.
Well, I think the big issue there is the ability to reclaim those assets. In other words, going back to work. If you spend the first 5 years spending down your assets, and let's say you retire at 65, 70, it's harder to go back to work. It's harder to find a job. And then we always talk about if you have the first 5 years of retirement being down years in the market, that's a whole nother issue. So you got this compounded loss. So you're drawing more money out. The market might be going down. And then how do you rebuild that asset? And again, people are living longer. You don't know how long you're going to need that money for.
Find out more about three-dimensional investing, utilizing insurance, brokerage, and fee-based planning with Ben Brayshaw, Seth Krussman, and John Ryder on their weekly radio program, Money on Tap.
Welcome back to Money on Tap. You can reach us at 855-226-8551 or email us at info@yourmoneyontap.com. We are talking about the aging demographic that we have here in the United States, and we've just touched briefly on how that is happening. I guess the numbers that are happening, about 10,000 a day going over the age of 65, and I got to tell you, I was thinking that's a big number for one, but that meant that at some point in time, 65 years ago, there was 10,000 babies being born, and those are some very busy doctors. And I wonder if they had
busy people back there. Seth, to have
a shortage of hospital beds at that time, or a lot of in-home births, or what was going on?
Look at this. From 1946 to 1964, there were 75 million babies born. The oldest of these boomers are starting to turn 65 now. So that's why we're having population, because people got home from the war, right?
Right. We're at the beginning of the tidal wave. That's what people don't understand. And that's why 2008 was such a catastrophe, is because all of those people were more aware of the value of their holdings because they were so close to getting ready to retire. Some even thinking about early retirement and getting fearful. Before, they probably would have just ridden it out. The strength of the hold inside your portfolio is what keeps the market afloat.
I think something that's interesting, and this is one of the things that's the challenge for this story, right, was the people that are drawing income on a portfolio. We talked about this all the time. The people that are drawing income on a portfolio that is cut in half. What effect does that have? And I don't know why people weren't just looking at the circumstance saying, okay, well, this is the time, the season, right? Because it's a bear market. On average, a bear market's a pullback of about 46%. Let's just call it 50. So why weren't people saying, oh, we're going to go into this bear market, we're going to experience 50% loss of what the general markets out there is experiencing. So they just didn't, there was no preparation, no thoughtfulness around that window for the majority of the people. They had just kind of been told, don't worry about that. Things are going to work out because we've got this allocation. We've got the backbone of bonds that is going to survive and going to create the income that you need, and that didn't happen. Or the CD market wasn't all of a sudden went from 5-6% down to 0.3, 1%. So why so much widespread panic if we know what's going to happen and we can prepare?
So adjusting those sales is an important thing. So going further on and talking about some more stats, just so people have a good understanding of what's going on in our country.
I'm still thinking about the 10,000 babies born every day. That's crazy.
Is it 10,000 babies born every day or 10,000 people retiring?
Well, no,
every day?
back then.
Back
when the baby boomers were coming. Yeah. Think about that. 10,000 kids popping out every day.
And that doesn't even account for the mortality factors that have happened throughout the years.
I like kids, Ben, but not that many.
But that's the low end, because the baby boomer daily turn is supposed to go to 15 up to 20,000 a day. There's a movement that number gets higher. That's a statistic I heard a long time ago. I don't know how accurate that is and where I got that from, but it's supposed to get higher than 10,000 a day. And so when you start thinking about the birthing experience there, man, there was a ton of babies in this country. That's really very interesting. I never looked at it in that perspective before. Thanks, John. Appreciate that.
So what does this mean? What does the aging population mean for the United States, and how should that affect the investing that you're doing? We on this website, there's shows a map of the United States, and it shows that every state here is going to experience an increase in senior population. There's no one that has senior population that's decreasing. The growth of the 65 and older population, they're saying it's going to be right now it's over 20% of the population in 2050 will be 65 plus compared to 13.7% today. So going from 13.7 up to 20%, and I believe from numbers that we've seen, guys, and the numbers that we've been crunching, is the fact that we see even more than that.
30%. These are I'm looking at this whole, it turns gray as it gets closer to being over 30% populated, and there's some major states here. I think the thing that we need to look at as an investor, as a firm, as we do investments for people, as we look at allocating things, as we look at breaking down factual items, there's two things. You've got the baby boomers and how they're going to invest, and you got the millennials and how they're going to spend. And those are the two biggest distinctions.
Millennials are spenders, aren't they? They're not savers, for sure.
Exactly.
We've seen that everywhere.
Yeah, and we've looked at all sorts of different things from the way they live in kind of the resort style living. That's been really interesting. That's a lifestyle that they like to live in. They like to eat out, fast food, lots, but they want healthier and some of those
more
things.
Expensive.
Yeah. So there's just a completely different way of living, and it's just really interesting. So, with the millennials, there's a good majority of them who don't want to own a home. They just don't.
They're renting more. We talked about this before in the metropolitan areas. Remember, Seth, we were talking about this in the metropolitan areas, in the Boston, Chicago, New York. They're renting. Rent is still pretty high price, but they're renting because they don't want the responsibility of owning.
They want quality places to live, but they don't want to
move around.
But they don't want to mow the lawn. So then you're like, well, do I buy a tractor stock? No, well, maybe not.
Maybe not.
Those are the kinds of things that people need to actually take some layman's thinking and apply, because if you're not thinking through these things, because we talk about the baby boomers, because that so definitely decides where investing may be right. But the spending power, if it's intentional and focused, you can start to grab from the millennial cycle. And, that's something where I think, you need to be the right kind of investor with the right kind of firm to really balance those two pieces as you do it. Now, going back to the ping pong illustration, Seth, we were talking about earlier, my thing about that is how, like right now in the market, right, we have been bouncing back and forth on the way up. You notice that? Like we ping-ponged the way down very quickly.
Yep.
But we're just ping-ponging on the way up. And I'm looking at it saying, well, institutional is getting stronger and thinking things look good. And then, more individuals get in the market and things look good. And there's a pause. And I mean, that's why we keep looking at these things and saying, well, why do a market update? It just keeps just ticking around the same area, and it's just growing, basically at a very slow pace, but a good pace. And those are things that are really interesting. And, I get calls like, hey, should we capture gains? Should we be reallocating? Tech's getting hit right now. Healthcare looks opportunistic. Those are the kinds of things that people are asking and saying, hey, I'm reading an article on this, or I'm reading an article on that, and what are your thoughts, and how do you handle that? And I think where we really need to – people are always looking for the individual ownership, right? They're always looking for that one stock, like it's the stock tip, right? And, what they don't understand is that there's ways to invest and there's ways to achieve. And we want to invest the way the largest investors are going to invest, in my opinion, which is going to be the baby boomers. And we want to achieve the returns from the millennials.
Well, I think this demographic shift that we're seeing gives us some great opportunities and gives us some great insight as far as how we're going to invest in the future and how portfolios should be positioned. And I know
you're officially a baby boomer, aren't you, John?
I guess I am. Born in 1970.
Wow.
Yeah.
No. Shame on you, Benjamin Brayshaw.
For bringing up my age. I guess I volunteered.
I didn't ask you. Yeah, I didn't ask you the exact
age.
age.
How dare you speak like that to your elder?
I think we should just start talking to John about what he's thinking about with retirement.
Okay, well, here's what I see. In regards to healthcare, we're spending a lot of time talking to people about ways in which they should invest and giving them advice in their portfolios. But here's one of the things, and I know, Ben, you've chatted a lot about this with clients, is that healthcare spending per person is nearly 5 times higher for those that are 85 plus than the national average of about $7,000 a year. So think about this. If we have an aging population and we have a much higher percentage that's going to be retired in our country than ever before, think about where they're going to be spending their money. Now, let's talk about that a little bit. If you are someone that's 75, 80 years old, where are you starting to spend your money? Maybe it's going to wind down a little bit on the travel end. And maybe you're going to start spending more money on what?
Apparently, if those numbers work out, $35,000 of that should be allocated towards the healthcare is what I'm gathering through that. And thank goodness that there's portion that is insurance. But yes, absolutely, that's a big shift in a spending pattern and a supply and demand story.
What I thought was really interesting. You're jumping into healthcare, so I'm kind of bouncing around a little bit here, but I'm in select your state. This is so interesting. So select your state. Now, I'm just going to brag a little because New Hampshire is my state, all right? And I love New Hampshire.
I can already see where this is going.
Well, you're a resident alien, John.
Yes.
So New Hampshire is second for America's health rankings, second in the country.
Mm-hmm. Mm-hmm.
Now, guess where Oregon is, Seth?
Oh gosh,
Health
probably
rankings
number
being
one.
healthy?
Probably we're probably either first or third. We're probably right there.
Try number 8. Get in line. Okay, John,
Try
where
number 8.
do you think Rhode Island is? And don't look it up.
Okay, I'm going to say number 3. Number 3.
14.
14. Okay.
So not bad. I was actually surprised.
Hey, great.
I was surprised.
Good story.
Well, I think it's interesting because, when you actually start looking at this, like, let's see, we got Virginia. Sheldon's down in Virginia. So Virginia's 28th. But compared to other states, their long-term care coverage, it looks like, or long-term care is 12th. So it's kind of interesting how these states swing on that. I was actually looking at that, and New Hampshire was a little bit better, I believe, on the long-term care side of things. Oh no, they weren't. They were 27th. So
what does that mean? Like when you say long-term care, like a better or worse? Like what is the evaluation kind of?
I think it's the care that people receive.
The amount of people that are receiving care?
No, like they're saying, listen, this is the best state to have, get long-term care from, and this is the worst. So New Hampshire's right in the middle.
Well, I'm looking at Rhode Island. The rank is really pretty bad. It's for affordability in rank, it's number 36. Yeah, that
doesn't surprise me.
Yeah.
Sorry, John. So I think what's interesting about this site is it gives you, we did that whole show, and if you're a listener and you haven't listened to the show, we talked about different places to retire. Remember we went.
I know where you can go listen to that show, but we'll get there in a minute.
Yeah, I mean, there's like places where it's tax friendly, it's least expensive. We did 2 bounces on the show on which one's the most economical, which is the biggest bang for your buck, and all that stuff. And what's interesting is that those aren't the only items people are looking at, right? People are looking at, where can I live that's the healthiest? Where can I get the best care? Where's my average income going to go the farthest, right? These are all things that people are balancing. And, this site does an interesting job on one side of it. It's kind of like these sites all do one side or the other. But it's interesting. I mean, I really find this stuff tremendously fascinating. The biggest issue that I actually see here is when you start talking about healthcare spending, right, and the amount of healthcare spending. Obviously, for the most part, the older you are, the more you spend on healthcare, right? So we got Medicare in this country, and it is honestly killing us. It is financially killing America.
Well,
and
listen to this. The ratio of the number of people that are working age compared to the number of people that are retirement age will change. So it's going to cause more strain on Social Security, more strain on Medicare, making it – and we've talked about the difficulty we've had in this area.
The amount of money we spend as a family, my young family, on health care is significantly low. But my bills are higher for the most part than somebody who is on Medicare, who is receiving the most of that. And that swing of the demographics that you're talking about, John, where all of these baby boomers are going to start needing medical help, right? That's the balance. Like, how do we provide that medical help? It can't get cheaper. It can't stay the same. We need more funds to pay for it.
One of the problems we've been talking about, we've had shows on Social Security here before. One of the problems that we're having is the fact that we have less and less people paying into a system where more and more people are retired. Listen to this stat. In 2000, there are 5.2 working age citizens for each retired citizen. This will change to 3 working age citizens for each retired citizen by 2030. That's a huge drop.
Well, yeah, it's an enormous drop, and the biggest problem is that we are fighting this. Like in our government is never going to touch anything until basically it's literally on the chopping block, and there's nothing to avoid because no one wants to be to blame, right, for Medicare getting chopped. So I'm getting chopped here by Seth. So go ahead, Seth.
You're listening to Money on Tap, and you can reach us at 855-226-8551 or email us at info@yourmoneyontap.com. You can also find us at yourmoneyontap.com. But we're going to take a quick break. We'll be right back.
Ben Brayshaw looks at building pensions and considering what you need to create freedom within your income on this Cliff Notes edition of Money on Tap.
We talked last week about putting all these little pieces to this larger puzzle together, right? So we talked about how to invest for taxes, how to do all these things and so forth, and how we have $19 trillion in debt as a nation, which is going to raise our taxes. We have these unfunded state pensions. Where are they going to fund them from? Oh, so more state taxes. So that's even more. So if you're talking about how you're going to build your pension or building your own pension, looking at how to build tax-free pensions is going to be highly important, or tax-advantageous pensions or reduced taxable distributions. Somehow, some way, you're going to need to create the ability to create freedom inside your income.
The looming tax issues, because of what you just laid out, starts to rival inflation as one of the predators as you start looking forward.
Right. So, we're always talking to people like, you've got taxes and inflation to worry about. taxes going up, and they say, well, I don't know. Well, are they going down? No one thinks they're going down. So when you put it in that perspective, people are like, yeah, they're going up. I don't think people understand how they're going up, why they're going up, and in the different areas that they're going up. People think, oh, well, this is what I pay in income tax, or this is what I pay in that. But we got state issues. We got federal issues. We got Social Security failing its funding. We've got states failing their funding. We've got a $19 trillion debt. How are we investing to deal with that?
And the vanguard of that is cities and towns that are failing.
Sure, municipal.
Yeah. So, and that's a big, huge problem. And I think if you're not evaluating that, then you take, like you said, Lou, the inflationary issue. If you can just get rid of the tax side of this and reduce your taxable distributions, then all you have to worry about is inflation. You have one unknown, not two or three or four. Right. So that's important, and more so, and that's why when people come through the door, we say we want to see your tax return. That is the first thing I want to see. I want to see how their life is being financially created, because if you can't, it's a sift. When we're kids playing on the beach, you take that sift and you shake it around and you get some rocks that are left over there.
Yeah.
That's what a tax return is. It's a sift that decides how much money you get to go through their sift. And that's how much you get to keep. So it's not how much money you make, it's how much you get to keep.
Find out more about three-dimensional investing, utilizing insurance, brokerage, and fee-based planning with Ben Brayshaw, Seth Krussman, and John Ryder on their weekly radio program, Money on Tap.
Hi, my name is Seth Krussman, partner with Brayshaw Financial Group and one of the co-hosts of Money on Tap. One of the biggest concerns and largest expenses people face today is taxes. Without thoughtful planning, taxes can destroy future retirement dollars, eliminating the possibility of a timely retirement or dreams of what you want retirement to look like. If you're like most people, you're getting closer and closer to retirement, and you may be wondering if you're taking the right steps. Will my income be enough? Will rising taxes force me to give up my dreams? How does inflation factor into all of this? These are real concerns, and you're not alone. Putting a plan around your financial future is what we do. If you have questions when it comes to your financial security, and if you're looking for a personalized solution, contact us at Brayshaw Financial Group, 855-226-8551. It's time for you to start getting answers to your questions. Headquartered in Bedford, New Hampshire, Brayshaw Financial has offices across the country. We'd love the opportunity to show you how we can help. There's absolutely no cost or obligation to meet with us. Call us at 855-226-8551. 855-226-8551. You're listening to Money on Tap. You can reach us at 855-226-8551 or email us at info@yourmoneyontap.com. You can also find us at Facebook at Money on Tap. Gosh, we're just about everywhere, I think. If you listen to podcasts, we're there. If you just want to take a look at the website and catch up on some of the episodes that we've talked about or we've referenced, we were talking about some of the best places to live in America based on did a couple of different shows on that, based on either kind of taxes driving that decision for you or, kind of this holistic approach on what's best for the retiring America. But right now we're talking about demographics. And Ben, I apologize for cutting you off here in the middle of a great speech. I'm glad it was recorded. We've had some poetry this session. We've had
culturally enriching.
Yeah, I have brought nothing to the table so far except for just I'm just going to let it go at that.
Well, I appreciate that, Seth. Back to my speech, John and Seth. My biggest problem is that what I see happening here with Medicare and healthcare and the whole crisis, right, is that either the elderly people in this country, these baby boomers and older, are either going to fork out a ton more money for the healthcare in this country, or healthcare is going to limit the services they provide to them.
It might be a combination of the two.
Right, and so you're now going to have someone judging your validity for life, and that's wrong, right? I mean, you're going to have someone saying, no, you're too old, you can't get that procedure. Because, well, when do we actually draw that line? I really think the fact that we have a national healthcare system only puts us into that box of having to define what's relevant to care for and what's not. And that ethical dilemma is something I don't think as a nation our government should be deciding.
Yeah, you
upon.
certainly don't want the government telling you what you're eligible for and what you're not,
Right.
based upon how much.
Which is why I think people need to define the value and cost of health insurance, and then actually let people pay for what they want to buy. Because if we don't do that, then the government's going to have to define what health care really means.
Well, there's a lot of votes out there in that demographic still that need to be accounted for. I think that they've got that's one of the things that's kind of characteristic of the baby boomer population is they really do have so much power in terms of the number of votes that they can cast, the direction that they can really form and shape a lot of ideals out there, and they're being kind of in this replacement period with the millennials coming through, and it's an interesting it's an interesting opposite kind of polar opposites in what's important to them, right?
Seth,
so
you and I are abandoned. I mean, we're Gen Xers, right? Is that what we are,
so,
Gen Xers?
We're the middle child.
Yeah,
and
I mean,
we're just going to slip through the cracks.
The redheaded stepchild.
We're going to get voted out of each side of this thing.
Yeah, nobody cares about
For those
me.
of our listeners who don't know, Ben and Seth are born in the same year, on the same day, in the same hospital. No, same hospital? I don't know. Oh, okay. Different hospitals.
We try not to advertise that, John.
Okay.
But you know what? We will secede to the elder statement. We will secede to the elder statement as elder statesmen here this afternoon. I respect you.
Okay, so big picture, guys. So big picture.
All right.
Big picture. We have people that are looking for guidance out there for, hey, how should I have my portfolio set? How should I have my allocations and all that? So, Ben, let's talk a little bit about what we talk with when people come into our office about ways in which they should be perhaps structuring their portfolio, different for different folks, different risk tolerances, that type of thing. But on a big picture, in light of our conversation today, what kind of things should we be looking at?
Well, John, we talk about everything under the sun. I mean, there's not really anything we don't handle for the most part in the investment world. But it doesn't mean you have to take a huge amount of risk in this world to actually make money because of this demographic shift. I think that's the real story that exists out there, and people aren't really giving it the credit and the validity that it needs. And we talk to people all the time saying, if the baby boomers are coming through buying up yield-producing, dividend-producing assets, those things are going to rise in value as the demand for them increases. We're at the front end of this tidal wave. This is an opportunity to take advantage of those yielding assets if you know what you're doing, because you can probably take less risk and potentially see better returns because of that shift, because of that tidal wave, because of the demand for income-producing assets by people who are retiring, because that's what they need is income. Now, at the end of the day, though, right, it may not be true. It may not work because you have the millennials coming through, and that's a whole nother swing. So you've got these polar opposites, that ping pong table going on between those two age brackets. Now, at the end of the day, those people are going to be spending, the baby boomers are going to be spending, and where they're going to be spending is not exactly the same kind of thing, but it could be. There could be some similar overlaps. But I think ultimately, kind of the traditional stock market investments where you have a certain amount of risky stuff and not so risky and real conservative and all that kind of generic malarkey, I think it has come down to that because the old story no longer fits the current demographic swing.
So it's not like it always was. Times are changing.
Yeah, times are changing. You think about, was it Lee Iacocca when he created all the different cars moving with the baby boomers? Why was he so successful? He made the minivan and then he all the different vehicles. I remember seeing a story about him and how he went through that, and he just kept meeting the desires of that age bracket, and that age bracket's coming through now, and they're looking for income.
Station wagon.
Yeah, they
station wagons, right?
They want something simple, and they want income. And that's one of the things why the bond world, the annuity world, the dividend stock world, the low risk portfolios are so attractive because they want that station wagon. Now, how they invest and who does what and where they put their money and how they use it, hey, that's all to each person's needs and concerns. But I think if you're not taking that scenario into play, you're going to miss the whole cart, and it's going to literally walk right by you and maybe trample you in the marketplace. And that's the thing that I'm concerned about. And we talk about this with everybody. Where are these people spending their money? Maybe second homes, vacations, their grandkids, food, utilities, all those different pieces. Those are the things that, a real opportunity. Now, where are the millennials spending their money? Now, you obviously want to own the store, the company, where they're going to spend their money.
Chipotle, Spotify.
Those are crazy
Apple
stuff.
Products.
Yeah. My kids always want to go to Chipotle. It's crazy. So that's one of those things that's happened. We got music going on over here, all sorts of fun stuff. Go ahead, Seth.
I have an alarm that's probably about to go off to tell us it's time to shut it down for the day. But until then, we have some great stuff going on. We have our website, for one, which is a lot of fun. We've got some pictures of Ben and John and myself out there at yourmoneyontap.com. You can also find us at several different podcast venues. If you're an Apple iTunes person, Spot or Stitcher kind of a person, we're out there. And just search for Your Money on Tap, and we should come up right there with you. But you know what? I think the big picture is what we're going to get back to here before we wrap things up. And I think it's exactly right, Ben. I think you're hitting the nail on the head, which is just people paying attention to supply and demand stories. And there's a couple of big stories right now, especially with the millennials moving in as a story, and the spending power that they're starting to acquire as they're starting to find, their education and they're starting to, possibly, hopefully pay off, and their income's starting to rise, and they're becoming more capable of having impact in this environment. But also it's the aging population what we're focusing on, and their needs in medical, in real estate, in basically needing income, and how to drive that outside of the typical paradigm, which has been get income from CDs or get income from bonds. Those have been the
But Seth, the one person's listening to you speak and to me, and they're saying to themselves, well, what about the next time the market crashes on me? What do I do? And those are the things that add a whole nother layer. That's where the planner comes in, right? I mean, that's the part, I think it's never been easier to understand demographic shifts. It's never been easier to understand all of the opportunities that exist out here. But because of that, the crisis for crash, those we talked about those flash crashes a few weeks ago.
You're not going to be able to remove the human factor out of that, of what people are going to do in response to that fear.
People are saying, I like everything he's saying, and we get that all the time. We get people calling and saying, yeah, that makes a lot of sense, but what about when it crashes again? What about this? What about that? And that's where the planner comes in, and that's why we talk so much heavily about either some sort of hedge protection, some sort of something to feel better about your portfolio, right? We've talked to people about annuities. We've talked to people about tactical investing. We've talked to people about insurances. Whatever the scenario is that helps them come to grips and give them a foundation. And that's probably something we should review again, is the foundational piece of everyone's portfolio and how people need foundations, whether they're building their house or they're building their portfolio. They need to have some level of security inside. Even if it's a CD at the bank, you need to have enough of a foundation that you can literally leave your house every day and know it's not going to fall down.
So proactive investing is what I hear, not reactive. So when something happens in the market, that's not the time to start making moves. The time is to start making moves now. And that's the time to start making positive decisions in your portfolio as far as adjusting the sales a little bit, maybe, as you see the different trade winds coming.
Yeah, I hear people get scared all the time. They say, well, I've heard bad things about annuities, or I don't want to manage money and fees, or insurance is expensive, whatever the story is. It's like, well, do you want to lose 37% in the S&P again, like 2008, and be out there completely naked in the market? I mean, you have to pay to help protect yourself, or to get advice, or to do those things. And I find people are a penny wise, a dollar foolish, and we're seeing a lot of that stuff inside. I mean, there's all the different funds that are out there that are doing some of these different mechanisms to try to create this or that.
Eke out a little more profit.
Yeah, and just and keep the fees down. It's like, there's lawsuits about this and there's lawsuits about that. It's like you can't get enough of this stuff. Everyone comes up with a new idea and then someone sues about it. And sometimes what's traditional and what's old and what has been working for many, many years, just because you want to be a little cost conscious about things, may not be worth it when it comes to your retirement. It's the person who lost 50% of their portfolio sleeping at the wheel on a passive S&P holding that's not somebody who you want to be.
And we have seen zillions of dollars pouring into those types of funds right now at a market high.
And that's where the flash crashes. That's what I mean. Institutional investors are saying we're concerned about flash crashes. They're literally scared because they don't know how to control it.
And the public usually gets that a little bit later, don't they? Yeah.
This last week, business and finance, Wall Street, tech stocks suddenly gets slammed. It's a crowded trade, which means that there's just a ton of people in on that. And when they start they start realizing, oh my gosh, we've got a lot of exposure in this area. They pull out, and that's what happens in a crowded trade. Is it pulls back, and it pulls back hard. And so long term, maybe not a great idea, but short term, maybe not so much. So is that everything? Did you get it all?
It's a wrap.
Did you get it all? I think we got it all in there today. You guys, this has been a lot of fun, and folks, you have been listening to Money on Tap. Now, I think there's one other thing. Now, Ben, last time you made this offer to our listeners, and we didn't really give them enough warning, and I don't think that they're really prepared for this, but one of the things we love to do is interact with our listeners. If you have something out there that's a show idea that you want on air, you have a question that you want us to go ahead and answer for you, if some way we're able to go ahead and use that and weave that into our show here, we'll go ahead and send you out either a hat or a shirt. Is that right, Ben?
Yes, that's correct.
Because we've got some fancy new gear here at Money on Tap. If you haven't checked out the logo and the gear, it's going to be on the website here shortly, but it looks good. I'll just take a picture with my phone and send it to you if you really need proof that it's there and that it's worth your time sending it. Okay, John, you don't get to dip in on this on the show ideas either. I know you've been trying to get some spoof emails in there for some show ideas, but that doesn't work for you.
Okay.
So
emails.
You've been listening to Money on Tap, and we're glad to have you join us today. You can reach us at 855-226-8551. You can also find us at yourmoneyontap.com. We're glad to have you listen, and we look forward to catching up with you next week, and can't wait to see what some of the ideas are from people that want to hear more.
John Ryder and Ben Brayshaw discuss the tendency to move an investment in and out of a plan, usually out of fear, and the importance of using a financial planner, a third party, to help ease the emotional ups and downs and make wiser investment decisions on this Cliff Notes edition of Money on Tap.
Well, I think that moving in and out can be very, very dangerous. But that's typically what a lot of people will do. But many times people will wait until the bad news actually hits and the market is down. That's when they start cranking money out.
I bet you everyone listening would probably say, if I pull my money out, it's going to go up.
Right.
If I leave it in, it's going to go down. We were talking with an advisor yesterday, so we'll actually handle other advisors' money as well. And some advisors admit, I'm really good at managing money for other people, but I can't handle the emotional swings myself.
There is definitely truth to that.
And there's a lot of truth. Yeah, there is. And it's just hard for people to realize that just having a third party give you that advice, that kind of unbiased, like, this is just what you should do in your situation. And we were talking to him about some investments, and he's like, oh, yeah, I know that one. I was like, yeah, that's the one you should own. He's like,
and he agreed.
And he agreed. He agreed.
Right.
It takes a lot of humility for an advisor to say, listen, I just don't want to manage my own money. I can't. Even though I do all this stuff, I'm not selling the stock when I sell it for somebody else, or I don't buy the stock when I buy it for somebody else. That's a natural concern. And I don't think anyone listening should be worried that, hey, it seems like every time I do something, I seem to be moving opposite of where everybody else is going. Or, I have a few winners, but, most of the time I'm like, I need to increase the number of winners I have. Those are the times when you say, let me just sit down with somebody. That's where people give us a call and they say, hey, how would you do this differently? Show me where your value is. And that's where we bring different stories to the table, and the three-dimensional investing comes in.
The views expressed are not necessarily the opinion of this radio station and should not be construed directly or indirectly as an offer to buy or sell any securities mentioned herein. Investing is subject to risks, including loss of principal invested. No strategy, product, material, or tool mentioned can assure a profit nor protect against loss. Please note that individual situations can vary. Therefore, the information, products, materials, or tools mentioned should be relied upon when coordinated with individual professional advice. Past performance is not a guarantee of future results. yields. This show may be subsidized in whole or in part by a product sponsor or issuer. Securities and advisory services offered through SagePoint Financial Incorporated, member FINRA SIPC, and a registered investment advisor. All other services offered through Brayshaw Financial Group LLC are independent of SagePoint Financial. SagePoint Financial and Brayshaw Financial Group do not provide tax or legal advice. Main office is located at 116 South River Road, Bedford, New Hampshire, 03110, and can be reached at toll-free 855-226-8551.